Let's look at how the Wespath funds performed in the first quarter.
Thanks, Joe, and hello, everyone. The chart on the screen shows the net of all fee performance of the individual Wespath fund versus their respective market indices. The first row on the chart is the multiple asset fund, which is our flagship balanced portfolio. As a reminder, this fund has a 65% allocation equities, 35% allocation of fixed income. The funds directly below the multiple asset fund are the 4 core Wespath funds that comprise it. The first column on the chart showcases the first quarter net of all fee performance results. If you move your eyes to the bottom of the slide, you'll notice that the Inflation Protection Fund is the only fund that ended positively on an absolute basis in the first quarter.
So while we're on the topic of inflation, or the Inflation Protection Fund, Karen, let's switch things up this time and start by talking about our 2 bond funds.
Yeah, sounds good, Joe. So as you can see on the slide, the Fixed Income Fund and the Inflation Protection Fund both outperformed their respective benchmarks net of all fees in the first quarter. Despite being down 5.88%, the Fixed Income Fund outperformed its benchmark primarily because of the fund's diversifying strategies, such as our positive social purpose lending program and the fund's overweight to high-yield bonds. As I mentioned earlier, the Inflation Protection Fund was the only fund that ended the quarter in positive territory and also outperformed its benchmark net of all fees. And the reason for the positive performance in the fund is the fund's 10% allocation to commodities, which ended the quarter up 25%.
So Karen, how did our 2 equity funds fare in the first quarter, given the volatility of the markets that we have seen so far in 2022?
That's right, Joe. The markets have been quite volatile since the start of the year, which has been due to the impact of inflation concerns, Russia's invasion of Ukraine, and the Fed's more hawkish tilt. Focusing on the 2 equity funds, which are the first 2 funds listed below the multiple asset fund in the chart. As I mentioned, these funds comprise 65% of the multiple asset fund and were the primary driver of the quarter results, which was stock selection by our active managers. I'll highlight in a moment specific companies that impacted the performance. While the U.S. equity funds underweight to mega caps, which are the largest U.S. companies, had a positive impact on the fund, as those stocks were down 12% in the first quarter, this was offset by poor stock selection by our active managers and also the fund's overweight to small and mid-cap growth stocks. Poor stock selection by our external managers was also the main detractor for the international equity fund's quarter performance. But on a positive note, the 2 equity funds' allocation to private equity contributed to the fund's performance as we saw strong results posted from this asset class for the quarter.
Karen, we understand the recent short-term underperformance, but are there any comments on the longer-term performance?
Yeah, the reason for the 1-year underperformance for the multiple asset fund was primarily driven by the manager stock selection in our U.S. and international equity funds. Also, the U.S. equity funds underweight to mega caps, what detracted for the 1 year, despite being a contributor in the first quarter.
So I know we said in the last webinar that the 2-year perspective is helpful because of the volatility quarter on quarter. It's been quite high. And there's been significant changes in the stocks that outperformed benchmarks in 2020 to 2021 and now in 2022.
Yeah, absolutely. If we separate out the 2-year time frame, you can see that the funds have performed relatively in line with their benchmarks.
And how do we look relative to other balanced funds?
Yeah, the chart on the screen shows the multiple asset fund versus a universe of balanced funds. And the reason we show this is we want to see how the multiple asset fund performed relative to other balanced portfolios that are currently on the market. We're using a universe that is compiled and maintained by Investment Metrics, which is a well-known reporting provider in the investment industry. So as you can see by looking at the chart, the multiple asset fund performed below the median in the 1-year time horizon, but outperformed the median in the 3, 5, and 10-year time frame. So for instance, in the 10-year time horizon, the multiple asset fund outperformed over 64% of other balanced funds in this comparison.
Thanks, Karen. So moving on, why don't you tell us about the individual fund contributors and detractors for the first quarter performance?
Starting with our multiple asset fund, I highlighted this on the performance slide earlier, but the primary detractor to the fund's performance was the underperformance by our 2 equity funds, which I will specifically highlight here in a moment.
So you highlighted earlier that we saw some volatility in the first 3 months due to a few things that you noted. So how did this impact performance in our funds?
That's correct. We have seen some major market movements so far this year, which have been driven by inflation, rising rates, and the conflict in Ukraine. This has had a negative impact on equity and fixed income markets. Starting with the U.S. equity fund, this fund underperformed its benchmark by 34 basis points for the quarter. Mega cap and large cap growth stocks were one of the worst performing market sectors in the first quarter. Therefore, our underweight to these stocks contributed to the performance. Also, our dedicated allocation to private equity and private real estate was a contributor. The primary detractor to the fund's underperformance was our overweight to small and mid-cap growth stocks. Growth stocks really struggled in the first quarter due to the negative impact the rise in rates have had on this asset class. Also, the fund's active manager stock selection in information technology, specifically e-commerce and cloud-based data management security companies like Okta and Snowflake, were down 33% in the first quarter, which had a negative impact on the fund's relative returns. Turning the attention to our international equity fund, similar to the U.S. equity fund, this fund's underperformance was primarily driven by stock selection of our active managers, specifically investments in e-commerce and biotech. A contributor to the fund's performance was the dedicated allocation to international private equity. Moving on to a question that we've been receiving from our clients is, what is the fund's allocation to Russia? In the international equity fund, it has been less than 0.5% prior to the onset of the war with Ukraine, and today it is less than that. I also want to mention that we have instructed our managers to not purchase any Russian securities in our portfolio.
Thanks, Karen. So moving on to fixed income performance, the equity market wasn't the only market that's seen some volatility, but we've also seen it in bonds.
Yes, the bond market traditionally has been seen as a safe haven for investors when the stock market is volatile, but this asset class has not been able to hide from the volatility we've experienced. The first quarter was the worst quarter for bonds in 40 years, and the main driver of the bond market performance has been the ongoing inflation concerns and also the Fed rate hikes, which the markets are pricing in 8 to 9 25 basis point hikes by the end of 2022. Despite the negative absolute returns by the fixed income fund, it outperformed its benchmark by 69 basis points gross of fees. There are a number of contributors that we've listed on the left hand of this slide, but the primary reason for the outperformance has been the fund's overweight allocation to our internally managed positive social purpose lending program, which provides affordable housing and community development in disadvantaged areas. Also, the fund's overweight to high-yield bonds positively contributed to the fund performance, along with issue selection by the fund's Core Plus and Global Bond managers. The only detractor to the fund performance was the allocation to emerging market debt, which was impacted by the increase in the U.S. dollar.
So moving on to our final fund, the Inflation Protection Fund. This is the only fund that entered the quarter in positive territory. So can you tell us how that happened given the negative performance across both fixed income and equities?
Yeah, the Inflation Protection Fund has really showcased its purpose, not only last year, but also this year, since inflation is a looming concern and will be for some time. As a reminder, this fund was created to protect investment portfolios against unanticipated inflation while providing a stream of income. It ended the quarter up over 1%, outperforming its benchmark by 81 basis points. The primary reason for the positive performance is the fund's 10% allocation to commodities. Energy, metals, and agriculture have continued to surge at a historic pace and ended the quarter up over 25%. Also, relative to the fund's custom benchmark, the fund is underweight UK inflation-linked bonds, and manager issue selection in the global inflation-linked bonds contributed to the fund performance. Despite the U.S. Treasury inflation-protected securities having better returns than other inflation protection asset classes, the fund's overweight allocation to this asset class detracted from the fund's performance since they couldn't keep pace with the fund's benchmark, which again includes a 10% allocation to commodities. Finally, similar to the fixed income fund, the fund's allocation to emerging market inflation-linked bonds detracted as we saw the U.S. dollar increase relative to other currencies, which also impacted this asset class. As I conclude my portion of the webinar, I think it's important to remind our viewers that the U.S. and the whole world has been confronted with another once-and-again lifetime event. We started 2022 with the Omicron variant lengthening the pandemic even more, and when that dissipated, we were confronted with Russia's invasion of Ukraine. All of this, with now historic levels of inflation and rising rates, have created even further uncertainty, and the markets hate uncertainty. Uncertainty can cause volatility, which can be difficult on investors because of the emotional aspect. And emotions around investing can influence bad decision making. Our goal at Wespath is to remove the emotion out of investing. We continue to remain invested and monitor our investment managers and their activities daily. We are here to work with our clients to ensure that we are continuing to invest on their behalf that allow them to meet their financial goals and support the mission of their organization.
Thanks for that performance update, Karen.